Okay, good evening, everyone. Thank you for coming for the second session of the story of the market. It's about how to read the order flow from the charts and have a deep understanding of what's going on under the hood of the markets. Before we begin, I would like to ask you if anyone been attending to the last week's session, please raise your hand so I know how much recap we should do. And if you also have some knowledge about supply and demand or order flow, please raise your hand and I'll know what is the level of knowledge here. Okay. Okay, good. I see quite a few. All right. Okay. I see it's we're about 50% people that been attending last week. So we'll do a recap, a fast recap. So the new guys will get to level up with us, and we'll continue fast for the pioneers to get some new stuff. All right, let's begin. Okay, so we're going to talk about the story of the market. It's a theory, it's a practice of how we can read information from the chart in a way that we really understand what's going on behind the scenes of the market. The market is a real environment where real people and companies and organizations and politics blends into that specific place, and it moves price because of all kind of motivations. And what we're trying to read from the market is what is the net motivation of the market? What will be the collective decision, the democratic decision that's made in the market? And when we understand that, we can predict how we would like to expose ourselves in an investment in the market at the levels that we predict that has the most possible odd for us to make a profit. And the thing that we're looking for are where buyers or sellers are waiting, on what levels they are parking their orders and waiting to enter the market. And it's very possible and very accurate way to do it by just reading the charts. What I explained last week is that this theory, this concept works on every market that has a lot of liquidity, meaning all the Forex, the big stocks on each market, commodities, futures, most of the futures, and but if you go to some pink sheets and garbage stocks, it may not work. So what we're talking about is how we can work in a very liquidated markets and instruments. Okay, so first let's get to know each other, and let me introduce myself. My name is Gil Ben-Hur, and I'm trading currencies since 2007. In around 2012, the late of 2011, I was introduced to price action and order flow analysis combined with supply and demand, and this totally changed my perception of the market. At that point, I was suddenly understanding what's going on in the market, and instead of just getting a checklist rule-based system, I switched to become a trader that understands and have a reasoning why price move this way or another. And since 2012, I started trading for earning, and ever since, my career is around in the surrounding of being a trader. 2 years ago, I founded the 5%ers Trading Fund, which is a fund that invites every Forex trader, experienced Forex traders, to trade, to come and being accepted, and if he's being accepted to trade for our funds, we fund him with 100% of the money, and we give you a contract to work for us. And let's talk about what is the 5%ers Trading Fund. We fully fund experienced Forex traders, and we bring and we provide all the capital for talented traders to trade for us, and we take the full risk for losses, but we do share the profits. It's about 50% that we share the profits with our traders. We provide unparalleled growth scheme, which which we give. We double the account for our traders. For every 10% that they're making, we double the capital that they manage for us. So in that way, they can grow into very big accounts very rapidly. And and actually, the whole concept for this is that we're creating a career opportunity for Forex traders. And like we said, we give you very high capital to trade, which is ours. You don't have to invest anything. It's 100% account financing. We're not asking for any payments, any subscription, anything. If you're good, you're going to be paid for everything. It's just like having your own job. You work from your own office, wherever it is on the planet. We give 50% of the share. We double every 10%. So you have the opportunity to grow as much as possible for you. And the only occasion that you should be paying anything is when you are applying for us. And the way that we know that you're a good trader is by making you show us how you trade. We do it with a live trading account. We call it evaluation account. We give you $10,000 to trade with. Whatever you profit there, it's 50% of the profits are yours. And there's only and the fee for that is only $400. So it's also good for intermediate traders that want to try and trade on their first live trade. So they live trading account. So they just invest $400. They pay for tuition, and if they're willing to trade with our rules which are very basic and very easy to follow, they will get $10,000 to trade with. It's a live account with 50% profit share, and you can read everything, all the information in our website. We're here to learn about order flow, so let's continue. And one last thing, and that's the reason I'm telling you all about this, is that if you know any good trader that may be suitable for our program in the Fiverr Trading Fund, please refer him to us. Let us know that you were referring him to us, and you'll get a cash reward for that. All the information is on the website, so if you know anyone, go to our website and see how you can earn from that as well, because we're always on the search for good traders. Okay, so let's start talking about order flow. Okay, today we'll do some recap about what we're talking last week. The concept of order flow, what it is, supply and demand basics, and the opportunity that lays in it. We're going to talk about the indications for level durability, meaning that if the level are going to break or hold, if they're going to support or break, we have by reading order flow and understanding order flow, we can have a good indication if that level will hold or break. So I'll teach you that, and we'll talk about another concept called consumption of the unfilled orders, which means that these are levels that we have no demand or no supply, meaning that we have no resistance there and price is free to go, and that's also a good indication what direction do we want to trade with on. Okay, so that's what we're going to do today. So let's rewind for what we did last week. Okay, first we were talking about two very basic markets. The very basic market that we see on the left side, it's a vegetable market, very primitive, very basic, and the stock markets, the very matrix, computer-oriented, high-tech, very, very fast-moving market. Are they by any chance similar to each other? Are they have any resemblances among themselves? So I will not make a discussion of it. The answer is they both the same. Why they're both the same? Because they both are a platform for a seller that's asking to sell a commodity, and a buyer willing to buy the commodity on agreed price. And that's all to it. If you have these conditions, you have a market, any kind of market. And the way that price is being decided on the market is by the agreement of the seller and the buyers on a price for a commodity. And it's very much the same on the stock exchange. The stock exchange, there's no trade and there's no price punched in the market if there's no seller and there's no buyer willing to pay a defined price for the share, for the stock, for the commodity. Okay, so that's Okay, so you're seeing the first. Okay, thank you for for telling me that the slide didn't move. Okay, now you see the right slide. Okay, good. All right. So Okay, so we have these two markets, and they are both the same, and they both work the same, and price change with the same conditions. If a seller trying to raise the price for the commodity and the buyer is willing to pay the higher price, then a higher price was punched in the market, and that's the last price of that tomato. If the buyer wouldn't want to buy the price that the seller punched, the seller may be asking for less until the buyer will come and buy. So that will define a lower price than punched. So price is going down. So it's pretty much the very same from the primitive basic market that we all know, and the stock markets, which is very complex and sophisticated technology, but it's still the same, very same concept, and price changes only by the same conditions whatsoever. Okay, so what is a demand and a supply? The rule of supply and demand are when you have pretty much on these two images, we have the same commodity, a lemonade, but we have two different situations that will create different pricing for the same product, right? If these two girls don't have any line standing in front of them, they would need to, and if they don't want to lose any efforts that they made on creating this lemonade, they will probably change their price to be lower until they find somebody that is willing to buy their lemonade. Okay, because they don't have a demand for their product, and they have a lot of product on the table waiting for buyers. So that means that they have a lot of supply with no buyers, meaning that they will be willing to not to lower the price until they get buyers to buy their product. But in the other situation, there are a lot of people that are very thirsty on a sunny, hot day, and there's only one place that would sell a refreshment, and they would stand in line, and this guy can see the large demand for his product, and if it was a free market and is willing to raise his price, probably more people would buy it on a higher price, and that's explain the rules of supply and demand. If you have high supply with low demand, price will go down. If you have high demand with limited supply, then price may be rising up. Okay. So in theory, what's going on is that, say we have a buyer and we have a commodity which somebody willing to sell. If we have a balanced situation where we have enough buyers to buy sufficient commodity, then price will just stay at a certain level and nothing will be changed. But if something changes and more buyers are willing to fight for limited supply, then price will probably rise, okay? Because the sellers will see that there's a big demand, and they will auction who is willing to pay for more, and only the ones with the deeper pockets will be able to get their hands on the product. And then if the same seller will bring more stocks into the shelves to meet the demand, price will be stable again on a balanced situation, and price will not change. And then sellers and then buyers maybe there are going to be less buyers for the same commodity. So in order for the seller to get rid of all his stocks, all of his investments, he'll need to lower the price, and the price will go down. It's in the market. Who will manage this? The official rule that will manage the price, if price will go up and down, is just the mechanism of if there are matching between buyers and sellers, meaning that when we're trying to when we're trying to buy a stock or buy a contract in the market, we would send this order to the exchange central, and this exchange central, they have it's a center where all these orders from all other terminals coming into one place, and now their job is just to make matches, to create as much as possible trades matching between buyers and sellers. So if we look at that situation, and this is exactly what's going on in the market, in the exchange. The exchange gets all these orders from people willing to buy or sell at a certain price the commodity, and they starting to match one piece of sellers and give it to a buyer, and they created a trade. Another one. So at one point in this situation, they're going to be the seller's trade will be finally empty, while there are still a lot of buy orders that are waiting, and they don't have a match. If they don't have a match, the exchange cannot make any trade, and the automatic resolution for that will be that price will go up, and they will look for more participants that are willing to sell to these buyers, meaning that there are a lot of demand to buy these stocks and less sellers, so price will go up. And this is exactly what's going on in how it works in the market. So how does it look on the chart itself? We see we can just picture the very same situation. The very same situation when we see a price basing in one place and then rising up, then we can just simply understand that there were less sellers in the market and more demand, and that's what makes price to go up. Very logic, right? Same thing for the sell, but now I'll show you what we're looking for exactly, and how we can find the precise level, the precise price that we can estimate that in there we can find more leftovers, where we can find more unfilled orders that later, when price will come back, these orders will be automatically executed in the market, and this will be our opportunity. I'll explain more in this presentation. So How do I get rid of this? Okay. Anyway. Okay. First thing we are looking for is where is the when we see a dip, when we see a lower low, and we're looking for the where was the last trade with the seller? Where was the last sucker seller that sold at the cheapest price, meaning done the worst trade for himself? Okay, so that will be at the lowest spike of the dip. Okay, next thing we're looking for where we see the last sellers before we saw a significant rally. What do we mean by that? Before we see that there is a rally, but we see that price is basing, returning back, and this is the lowest point before price really shoots up. So I would mark this place where I would call it the last seller before significant rally. So I will mark it. This is the last seller. And then I will look for what, once we had this last seller a bar, we need to ask ourselves what was more significant with by that. It had to break something before. Let's say it had to break this high or this level. So this, we would call it a decision point. And this decision point is where we assume that order flow is waiting. The unfilled orders that we see on the after we were trying to match sellers and buyers, and all the sellers were gone, and the sellers tray was empty, and there and remember there were left a lot of orders for buyers that didn't have sellers to match with. Okay, so all these orders are waiting here on that decision point, and what we assume that they are waiting here, and we are taking the whole zone, the whole place from that decision zone to the lowest low, to the worst seller point. We call it the demand zone. Okay, so any visit of price, revisit of price to this area, we can take a wise risk to buy from here, because we assume that the leftovers, unfilled orders are waiting to be filled again, because last time that all the sellers were gone, so orders are left there. Okay, same situation we can find on a sell, on the opposite, for a short trade, for a short potential trade. And with that, the conditions will be where we see the worst buyer. The worst buyer will be at the peak, at the last peak of that spike. That was a trade. Remember, there is no price punched in the market if there weren't, if there wasn't a trade, if there wasn't an agreement to transfer a product, a commodity, between a buyer and a seller. So that means there was a trade there. So that trade was a very, very wise seller against a very stupid buyer that bought this very high, expensive commodity. So that would be the top barrier for our zone. And then we're looking for, we see that significant drop, okay, and we're looking for where do we see the last buyer before the significant drop, and we see that price went down and up. This is the last buyer of the significant drop, and from now on it's only drop, so we'll mark it. Okay, and where would be the collective decision point? It's probably going to be here or here, because this level had to be broken, and it's part of the base. So that would be the decision point, and our supply zone to sell the commodity, the equity, would be from here to here, from this low to this top. If price will visit this area again, then we can make a wise decision to sell the equity. Okay, so this is how we define our supply and demand zones, and supply and demands are just part of order flow, and you can go and read it. There's a lot of literature about this. Okay, let's continue. So I will read questions later, because I cannot really focus reading questions and doing the presentation. So I'll read it later on. So okay, just bear with me. Okay, please. Okay, so we have few. Let's lay out few more terms to help us to make our order flow language more sophisticated, so we can be more sophisticated in our risk taking. Okay, so markets always move in zigzags. Okay, and for somebody that doesn't understand what he's seeing, sometimes it may look like a random situation where there's no explanation for why is price moving like this. Okay, I hear a lot of very well educated traders that saying that they cannot explain what happened here and what happened here. They just call it price. The market is undecisive. When they show me that there is a definite decision, then I'll jump in or go out, whatever. But if we try to read the order flow at any position here, there's a reason why price go up and down. The truth is that after sense, we can give logic to everything that had happened by order flow, but we cannot always predict that, because sometimes we have levels that would work more than we anticipated. Sometimes we have it less, but afterhand we always have a good explanation. So don't blame me for just give you reasoning after things had happened. It's really work like this, and as much as we learn and do the aftermath and learn the aftermath of this situation in the terminology of order flow, then the next time where we're trading on a real-time situation, we can take wiser decisions in our risk taking. Okay, so so we have four situations of markets moving. We have a rally, base, and drop. okay, meaning that we have a reversal situation. We also have a drop, base, rally. So it's a reversal from moving down to up. Okay, so we call it RBD and DBR. And we also have the continuation price action, which is drop, base, drop, and drop, base, drop, and drop, base, drop. So these are situation of continuation, but they all have, if you look at them, they all have the ingredients that we just talked about in the last slide. They all have the worst seller, the worst buyer with a decision point, and that decision point hides orders in it, even if it's a continuation. When it's a reversal, a rally-based drop, we also have the worst trader and the significant last buyer, and then the decision point. And if we will mark them, we can see what happened in the future, in the past future, okay, what happened on that decision point or in that zone, how price reacted when it came back to that zone and to that decision line in specific. Okay, so it's important to have a distinguish between the reversal price action, which are much more important than the continuation price action, but also the continuation price action, they have the very same features, and they have the order flow hiding there for us to discover and take advantage of. It's very good for our continue to add on our trade, or to make sure that we are on the right side of the market while we're in a trade already. Okay, so these are very important things to understand. So we can just go and we can do it as micro as we want on the market. And what we can see here is I created some iconography for showing the order flow situation, because this is what we're trying to read. We want to read on the market if we have demand, order flow, leftovers, unfilled orders, or balanced, or supply unfilled orders. Okay, so these are only three types of icons that I've created, and if we just go step by step on each and every twist and turn on the market, and we can go lower time frame and higher time frame and the bigger picture and micro picture, whatever, we can just plot the situation of the order flow at every base and spike in the market. Every impulsive and every base is an order flow statement. Okay, so we have a base, and it's and we have equivalent amount of buyers and traders, and then price drop, it means we have more sellers, and then price base again, we have another balanced situation, and then price drop, we have more sellers than buyers, right? And then we're basing again, and then we're dropping again, more sellers than buyers, and basing, and now we have more buyers than sellers, and basing, and more buyers than sellers, and price rising and basing and retracing a little, so we have more sellers than buyers, basing, and more buyers than sellers, so price is up, and so on and so on and so on. And this is how we read charts. This is what's important. Why it's important? because of the unfilled orders. If we had this situation where we have more sellers than buyers on this decision point, on this significant drop, the beginning of the drop, we assume, remember the trades, we assume that we have more sellers in this situation. So next time price will come to that decision point, these orders will be triggered. They're waiting there. Okay? So this is why we read order flow and only order flow. And to tell you the truth, it's much more simpler than any other system that you will ever learn in the market. So just bear with me on that and you'll be very rewarded for the rest of your trading career. Okay, so here's the decision point, okay, of this drop. And look what happened when price returned to that decision point at the first time. Okay, there are more decision points, and if we mark every decision point on the continuous or on the reversal situation, on the rally-based drop, or the drop-based rally, or the drop-based drop, every situation, almost every situation is being triggered these unfilled order, and price would be at least bounce at this, react to this to these unfilled orders. Not every time it's going to be a reversal, but the bounce you will get. And if you trade and if you analyze higher time frame, these bounces will create you a lot of points to take from the market just on bounces without even reversal. Okay, so here's another decision point before dropping down, and look, when price came in, it gave us a bounce. Okay, here's another decision, and when price came in here, it gave us a reaction, not very beautiful one. Okay, but we have here another decision point, and when price came back, it gave us a nice reaction, and then another reaction, and then a third reaction. And after the third reaction, this whole area was already consumed and price was free to go, but only after 3 touches, and it gave pretty much good quality of. And here's another decision point which didn't work. Maybe it worked on a very low time frame, but it's not important. Not all levels will work, and we will learn if we can understand or predict if these levels will be working or not. But the rule of thumb for that is that most of the continuous levels or zones are having less significance than the reversal ones. So you give them less credit, less points before you just trade them. So don't just trade them on a blind set and forget style. Okay. So we're just showing, and it's very important that you do these drills. You go to the charts and you're going to mark these zones, and you can stretch these rectangles to the right and see how price reacted to the first touch of that decision. The decision was made here, and price was slightly touching back and going back, and then gave a nice reaction and gave a third reaction here, and then after that it was free to consume the whole area and move on to the next one. Okay, so same thing. So we saw examples of many supply levels. We also have on the demand. On demand here we have a decision point, and then first touch gave a very nice reaction with higher high, even breaking these highs, and then price went back gave a nice reaction, but this was already consuming this zone. And then when price came back again, it consumed it totally. So this zone is not relevant anymore, even though we see it did hold on the lower, but on the lower level, but probably we had a lower level from the left history that that reacted to this. So with supply and demand and order flow analysis, you always have the opportunity to go left and understand why this had happened. And many times, if you be very very stubborn about understanding each and every turn, you always you'll put your line here and you'll go left as much as possible, as much as you have data, and you'll see the reason why price had jumped here, and try to understand it in an order flow. Try to picture yourself the trays, see the red and the green proportion. If you have more reds or more greens, and you see that price is very, very sensitive to unfilled orders, okay, to order flow. So try to talk order flow when you reading the charts. Okay, so here's another decision point where price was rallying up, and then when price came here, it gave a little reaction, not very significant, but it did give a few points. Here's another one, and price was dropping, giving a retracement off that zone, and you see, even if not all zones are tradable, they all give you an explanation of events and behavior of price. And that's very, very important that you have deep understanding why price is bouncing and how much it's going to react to zone. And if you do it in a very micro level, you will be able to understand, I would say, almost 90% of all these spikes that you see here, you can give them a reason. And if you do it, if you practice this kind of reading and this kind of back reading, giving reasoning for all these spikes, you would be very, very benefited in your trading afterwards, because you'll gain a huge understanding of how market works, how price works. And I must tell you that regardless of what we're saying, we have a lot of reasoning why things happened, but you must not forget that sometimes the market has events that would wash and will not consider these levels at all. In cases where we have a very big announcements and economic news, or a very big event, or Trump had tweeted something. Sometimes the events brings so much motivation into the market that it would wash away little stocks of orders that waiting there. The opposing traffic of orders would just wash it, and it will not create any reaction. So that's also something to mind, that sometimes big events brings so much participants into the market that order flow at very low key amounts will not hold the price. Okay, so you must understand that as well. Okay, because market is driven by these events as well. Juan is asking if we can use this tactic on any time frame. The answer is yes. What I'm teaching you is a way of understanding the market, and it works on any time frame, on any equity, and it's actually on every market. You can do it on stocks, on commodities, on Forex, on futures, on ETFs, on indices, whatever has a lot of liquidity. Like I said in the beginning, it's going to work, and you can trade with. You can do scalping with this understanding, and you can also do swinging and very long-term trading. You can just take the understanding of order flow and the unfilled order theory, and you can do with it whatever your personality, whatever trading personality you are. You can make a very, very good use of it. Okay, so we saw how we analyze where we might have unfilled orders of buying orders or selling orders, and with that we would want to enter the market where we assume that there are unfilled orders, because we want to take advantage of the orders that are just waiting there. Okay, but as much as we analyze where the unfilled orders are, we also need to be minded to where we don't have unfilled orders anymore. So we have a thumb of rule that saying that after the first visit to the zone, we are going to question the level. It will not work forever. It can work once, it can work twice, it can work 3 or 5 or even 10 times. But the only thing that we are sure of, and the less visits that price made to that level or to that zone would be the more risk that we are willing to take. And my thumb of rule is only the first visit, meaning that the only time that I have the most confidence, and it's never 100% confidence, but the most confidence that I would have in taking a zone is when it was unvisited at all. Okay, so what I would look for a decision where price never tested it before, and we have plenty of opportunity for that, because we have all the time frames, and we have all the instruments, and we have so many events. We have so it's just endless opportunities. By the way, a trading order flow will give you endless opportunities during the day itself. It's not like other systems that you have to have all your technical conditions aligned together, and you might have very few situations like that you can enter the market with them. With order flow, you actually waiting for price to come to your level, instead of you waiting for the event, the condition to tell you to go in, and it can be on a few times a day. We can dive to lower time frame and have many situations at one day to enter or to exit the market. So it's another good advantage to work on that terminology. Okay, so what I said there before is that we're waiting. We want to trade only the first visit, and after price had visited at the first time that level, we will consider that level to be wasted or to be questions. We will need to have more confirmation if we would want to trade it. But let's now try to think how a zone is being consumed. Okay, if we have this decision to go lower, and we see that price has already went lower and then it punches in, so it may take the unfilled order that were there when the decision was made. Okay, in my thumb rule, I would say I don't want to sell this decision. Maybe I would want to sell this decision because this decision was not visited before, but this one is already visited very, very soon. So price did give a reaction, and then so it's the third time that it visits this zone, and we starting to think, okay, the unfilled orders were there. Every time there are a lot of selling orders waiting for buyers, right? Okay, so every time the price come and visit, the stack on that selling shelf in that in the central bank, okay, in the central exchange, it will the stack is going lower and lower every time we visit. Okay, so it went it comes here 1, 2, 3 times already, and then the fourth time, and then the fifth time, and we see every time the price is pushing higher and higher, meaning that it's eating the stocks that are lying there. It's eating the papers, and eventually, when it comes into the sixth time, this zone is not reacting anymore as a sell zone. Okay, so the way that we need to consider this zone is that only after the first visit, the second visit, we assume that that the order flow in that zone is being consumed, and we assume that price has a good potential of breaking this level. We saw that in this example that it did give some reaction, and sometimes it was good reaction, but we cannot be sure of this. This is why we punching rule of thumbs. Okay, and we in the next session we'll talk about confirmation, and maybe we'll have the answer to how we could take this short trade, and enjoy this down motion. But for now, with the knowledge that we have now, we cannot take it. So after the first visit, we treat the zone as it's being consumed, and we're not going to take it unless we understand something else. And price, from our point of view, is free to penetrate the whole zone. Okay. Here's another situation. We have a supply zone printed, and we have a decision to break lower, and price came visit first time, gave a nice reaction, and then after it gave only one reaction, we assume that there are no orders in here, and next time price visit, it just penetrates the zone. So that's consumption. When we have a situation where price after touch the first time, we changing our program to say that this zone is breakable. Okay, it's fragile. It's the order flow are not clear to us, and we don't want to trade it, and we suspect that it may be going to break very, very soon. Okay, another thing that can help us in our assessment if the zone will break is that if we see that the price is coming from a demand. Okay, we see that demand was printed, and we see higher lows all the time, and price is coming in an uptrend context. So we can just apply a very simple logic to it, and we see a higher lows making an uptrend, very, very visible and beautiful uptrend, while after we visited one time and consumed the leftover unfilled orders. So we can give less credit to that zone and say it's going to break soon, so we don't want to sell it anymore. Okay, so add more understanding of what you see from the chart. Okay, here's a example of demand printed, and here's the rally, and here's the decision. Price came to visit at the first time, and then we can take it. But after it took it the first time, we assume that there are no demand orders in here. We actually don't know. Price did break higher high, come from higher high. We need to check why this happened on the left. Okay, if it's not a very significant zone, but if it's not, maybe we can take it the second time. Maybe it would be a confirmation to try and take a risk in taking this, but it's a very, very high risk. So we have a second visit, and it gave a nice bounce, but we will not take it because our rule of thumb will not let us take it, because there are we don't know how much order flow is waiting here. So we're not taking it unless we know something else. Okay, but eventually it holds, and the second time it holds, but the fourth time it's not working anymore, and it's broken. There's no demand zone in there. So this is the lesson for today, and I hope that we learned something new. As much as we want to analyze where the orders are hiding and waiting, we also need to give mind to where they are not there anymore. Okay, or where we have less probability to have orders in there. And if we have less probability, we should look for more clues from around, and these clues will help us to maybe take another risk, maybe half the size of the position to try things, or maybe not taking it if you're very conservative in your trading. But the understanding will help you a lot in defining what you're going to do with your open trade, with your exit, with your entries, with your decision making in the market. So if anyone has questions, please place it now, because I cannot go much up and see. If not, okay, the webinar will be published in investing.com, recorded webinars, and also we might publish it in our YouTube channel. So anyway, it's going to be available for you within a day or two to rewatch. Next week we're going to next week we're going to talk about more aspects, and I'll give you more ideas of how to do multi-time frame analysis and help you build a bigger picture understanding of what's going on and how to consider the market context and how to trade with more probability when you consider supply and demand in combination, meaning where price is coming from and where is it going, where are the bigger targets, where are just the tactical small micro targets that the price should go, how do we enter, how do we exit, and stuff like that. We also might talk, I don't know if time will allow, we'll talk about fake breakouts, why many breakout traders fail a lot, and because of many fake outs. Just look at this one. See how many fake outs there were. Here's a fake out. Here's a fake out, and they're just taking stops from all the breakout traders, and we can actually make a lot of money just trading fake outs if we understand that. So if you bear with me on the series, you'll get a lot of concepts that may help you in the future. And okay. If you go to our about our YouTube channel, you just need to look for the Fivers trading fund in YouTube, and you'll get it. And it's a rather new channel, so I don't know if you find it. Anyway, the safest way to find the recording would be on investing.com. It's going to be there next week, the next few days, if not next week, and for sure it's going to be there. But come here next week, and we'll dive deeper in that beautiful concept of order flow analysis. And all right, so there's no specific questions. You can write me if you do have questions. You can write me to this email, or you can just make some and practice whatever we were talking about. Do as many charts and mark on the charts all the time, and try to understand every peak and every dip of the market, and go to the left and try to understand it. Try to build your understanding, and you'll get more enlightened in understanding why price are moving this way or another. If you do it as your assignment for next week, I'm sure you'll have great questions for next week when we talk about a few more concepts of consumptions and order flow and hidden order flow and stuff like that. All right, guys. So thank you very much for attending. Hope to see you next week. Remember, if you know any good traders, or if you are a good trader, or if you want to try out for our fund, or just to play with live trading account without actually opening one, take a visit to our website, thefires.com, and find out what opportunities we have there. We have opportunities for beginner traders as well as to very experienced traders. Just be my guest and come there and send us questions if you do. And see you next week. Thank you very much for coming. Good night.